Hi everyone, we are Group E and we are going to present our presentation on TACC 605 Corporate Accounting. And here is our table of content, and we are going to talk about 5 points. The first is about the difference between accounting profit and taxable profit, and the second is about will the income tax expense for an accounting period be the same as the income tax payable at the end of that accounting period. And third, we are going to talk about why would a profitable company potentially not have any income tax payable to the relevant taxation authority. And next, we're going to talk about would incurring a loss for tax purposes lead to the recognition for tax-related assets in the financial statement and providing the reasons. And the last point we're going to talk about is what action should be taken when a tax rate changes and provide the justification of this. And I'm the first one to present the differences between accounting profit and taxable profit. So first, let's take a look at the accounting profit. It is the total revenue minus the explicit cost, which in other words, accounting profit is a company's total earnings, and it is the net income earned after subtracting all dollar costs from the total revenue. So what is the explicit cost? It is the cost that including labor, inventory needed for the production, raw materials, as well as the transportations. So if a person start a business using $5,000 and the profit he earned is about $10,000, so the accounting profit is equal to the $10,000 minus the $5,000, which is equal to the $5,000. And in this slide, we are going to talk about the taxable profit. If you are running a business, this is the most important profit that you will need to consider. As taxable income is used to determine your tax liability for a certain year, we need to consider wages, salaries, and bonus because they are sort of the investment income. It is the amount of tax an individual needs to pay and combine both unearned and earned income. The most common example is the employee compensation, which is about salaries, wages, and etc. The company will need to report this taxable income to the government and see how much they will need to pay. And it is usually less than the adjusted gross income as well. And here is a conclusion table that explains the differences between them. And we can say that accounting profit is to assess the company overall profitability in a specific financial year, while taxable profit is to identify the tax payable by the company in the previous year. In conclusion, both of them, including accounting profit and taxable profit, are correct in their place. Accounting profit is calculated as per accounting principle and assumptions, while taxable profit is calculated per tax prescribed tax rules.
Thank you, Yihua. I'm Dan. My task here is to explore whether the income tax expenses for an accounting period will be identical to the income tax payable at the end of that period. To begin, let's clarify these two concepts. Income tax expense refers to the aggregate amount included in the determination of profit or loss for the period in respect of current tax and deferred tax. This figure is determined based on accounting principles and rules, and it is reported in the income statement. On the other hand, income tax payable represents the actual amount of tax company owes to the Australian government at the end of an accounting period. It is the final tax liability that needs to be settled, taking into account any tax payments or credits made throughout the year, and it is determined by the tax legislation based on the taxation assessment rules. Those rules are not necessarily equivalent to the accounting rules used in the calculation of accounting profit. So, obviously, the answer is no. This slide shows how income tax expense is calculated. From these equations, we can find some clues about why the income tax expense and income tax payable are different. The difference between the income tax expense and income tax payable can occur due to various factors. Firstly, timing differences play a significant role. A company might have earned revenue in one accounting period, but it is taxable in the subsequent period due to differing recognition rules. Secondly, non-deductible expenses. Certain expenses incurred by a company may not be tax deductible. for example, fines and penalties. Secondly, tax credits and incentives. Companies may be eligible for tax credits or incentives provided by the Australian government. This reduces effective tax rate and resulting in a lower income tax payable than the income tax expense recognized in the financial statement. Lastly, carry forward of losses. If a company incurs a loss in one accounting period, it can often carry forward that loss to offset against the future taxable income. Understanding these differences between income tax expense and income tax payable is crucial for stakeholders, as it provides insights into a company's financial position and tax obligations.
Thanks, Dan. Today, I will discuss why could a profitable company potentially may not have any income tax payable to the relative taxation authority. There are some reasons contribute to this fact. The primary reason is that the use of tax loss carryforwards. If a company experiences high income tax loss during its early stage or some particular years due to economic or environmental conditions, Australian tax laws permits offsetting these losses from profits in the next few years. This practice is known as tax loss carryforwards. According to The Guardian, a news media company, over 30% of the Australian profitable companies, including large corporations, did not pay taxes from 2019 to 2021. And Qantas is a good example of a company using tax loss carryforwards to achieve a tax-free status. ABC's news highlight that even earning significant profits in 2019, Qantas has not paid any taxes since 2009 due to its historical tax losses, which can be offset against future profits. Also, excess depreciation plays an important role in companies achieving zero taxation. It is because excess depreciation enables a company to reduce its taxable income without tax deductions. The depreciation expense incurred by a company reduces the earning on which taxes are calculated, therefore reducing the tax liabilities. And Energy Australia is an example of this practice. Between 2006 and 2016, Energy Australia did not pay any corporation tax because the company has written down the values of its assets by around $2 billion since 2016. The next reason relates to the business tax deductions. Companies can claim many deductions, such as daily operational expense and service related to their business operations. Lastly, tax incentives and concessions also contribute to tax-based practice. The Australian government offers a number of concessions, including those for small business and tax incentives for early-stage investors, aimed to reducing or offsetting tax rates. So these reasons explain how a companies can be exempt from taxation, even those being profitable.
Thank you, EE. Moving on to the next part, we will discuss whether incurring a loss for tax purposes lead to the recognition of a tax-related assets in the financial statements. In essence, a company can make a tax loss when the total deduction you can claim for an income year exceeds your income for the year. One of the common scenarios leading to the creation of a deferred tax assets is when a company has effectively overpaid its taxes or has made payments in advance, or a company incurs a net operating loss for tax purposes. This happens due to the discrepancies between the way income and expenses are recognized for financial accounting purposes. In this situation, a company can carry forward this net operating loss to offset taxable income in future periods. This carry-forward mechanism essentially established an asset for the company, an amount that the company can use to diminish its future tax liability. Besides, certain deduction cannot be used to contribute to a loss. A tax loss is different from a capital loss. However, the recognition of a deferred tax asset is not a process that should be taken for granted. A company needs to make sure it will generate enough taxable income in the future to use these assets by evaluating the balance sheets. If the future profitability seems questionable, the assets must be offset by a valuation allowance, effectively reducing the net deferred tax assets to the amount that is expected to be realized. In conclusion, a loss for tax purposes should not recognize a tax-related asset in the financial statement. It is significant for the company to manage financial health and strategic tax planning to carry forward the net operating loss to offset income in future periods.
Good morning, everyone. Today I'll be discussing the action that should be taken when tax rate change. So firstly, I am going to introduce about the tax rate. Tax rate changes are a common event in our dynamic economic landscape. They impact individuals, businesses, and all over economy. When tax rate changes, it is crucial to raise awareness and communicate the new rates, effective dates, and reasons behind the change. Clear communication helps taxpayers understand their obligations and plan accordingly. Then we need to do some education and training. Tax professional and software provider need to be equipped with the necessary knowledge and skills to implement the new rates accordingly. Ongoing education and training programs ensure they can provide accurate advice and update their systems. Then we need to review update tax policies. Tax authorities should review and update tax laws, regulations, and guidelines to reflect the new rates. This ensures legal clarity and helps taxpayers understand their obligations. Forms and reporting procedures should be adjusted accordingly. Then we're gonna talk about the system updates. Government tax systems include online portal and payment platforms must be updated to accommodate the changed tax rate. This allows taxpayers to accurately calculate their liabilities, submit returns, and make payments without technology obstacles. Then we need to do some monitoring and enforcement. Tax authorities should strengthen monitoring, conduct audits, and enforce compliance to prevent tax evasion or non-compliance. Clear guidance and support should be provided to help taxpayers understand their obligations and avoid penalties. Okay, so in conclusion, when tax rates change, actions such as raising awareness, provide education and training, review tax policies, updating systems, and ensuring compliance are essential. By taking these steps, we can navigate through tax changes successfully.